I'm actually hanging around here to moderate the next panels, which focuses on the macro outlook for next year. So could I please welcome the next group of panelists? They are Luke Bars, Chief Business and Client Officer for Fundamental Equity at Goldman Sachs Asset Management, Dan Kemp, Chief Research and Investment Officer at Morningstar, Aaron Anderson, Senior Vice President of Research at Fisher Investments, and Gerard Lyons, Chief Economic Strategist at Netwealth. Welcome all. Thank you for joining us. And I think that the first thing to do is, in a sort of relatively quick-fire fashion, if we may, just address the exam question of the panel, which is around market turbulence next year. In advance of this event, we undertook some research of 300 institutional investors, at least 50% of whom work for investment houses with more than 50 billion under management. And we asked them a bunch of questions, so you'll see data points throughout the morning from that research. But one of them involved what next year looks like, and 92% of investors said that they think equity and bond markets in 2026 will be even more volatile than they were in 2025. So perhaps we start with that and just get your reaction. Aaron, I'll perhaps start with you.
Sure. Well, I've been in this business long enough to know that predicting volatility is usually not a winning game. There will, of course, be volatility, but maybe I'll get us started with a little bit of a controversial take in that in terms of volatility that might be spurred by President Trump and his erratic policies and things like that, I try and think about what are his motivations for next year. And I think winning midterm elections for the Republicans is going to be a key one. And so, we all know how Trump operates. He, is prone to send out a tweet without much thinking behind it and see how the market reacts and see how his base might react and then adjust as necessary. It's kind of the source of the taco trade so far for this year. And I think one could argue that if 2025 was the year of the taco trade, 2026 might be the taco trade on steroids to some degree, maybe the chimichanga trade, something along those lines. Because I think he's going to want to go into midterms with a sense of calm. He's going to want to appeal to his base. He's going to want markets doing well. And so certainly I see lots of potential sources of volatility next year. We've got midterm elections. We're going to get a new Fed chair. There are lots of things that could spur some volatility. I'm just not so sure that it's necessarily going to come directly from President Trump, because I don't think he views that as his most expeditious path to success in the midterms. I also think, to some degree, the market is, for better or worse, just getting used to his forms of communication. I mean, it just doesn't react the same way to every tweet or truth or whatever you call it, the way that it once did. And so I think, for better or worse, the market understands that these are just kind of thoughts he might have, spur-of-the-moment thoughts that he might follow through on, he might not. But the market doesn't react in the same way that it did. If I'm thinking about sources of volatility next year, probably NVIDIA's earnings and margins and all of that is just as important as what President Trump might do.
Yeah, no, I think it's a very good point that it's not, unpredictability is not all to do with the identity of the President of the United States. There's plenty of other reasons for it as well. I mean, and just while we stick on this topic, perhaps, Luke, what your reaction to...
Yeah, I think we're fairly balanced on volatility going into next year. Again, I take Aaron's point. I don't think it's something that's particularly easy to predict or try and trade. But from an equity market perspective, you think about what we've seen this year, right? We're back to 16 in terms of VIX, so kind of long-term average is 15. So you're kind of back to a normal range, but you peaked out at 55 plus, right? And so you've seen spikes through the course of this year of volatility that reflect a geopolitical backdrop that's challenging in certain pockets. And I think also, to Aaron's final point there, an equity market that is more concentrated and has more retail participation. Yeah. And so where you see some of those events that trigger volatility, they're being amplified in terms of what the market is then doing. And so we look at it and say, okay, go into 2026, there's good case for why volatility can be fairly muted. You have a decent backdrop in terms of earnings and fundamentals. Yes, you've got some bifurcation in the consumer in the US, but growth for the most part looks relatively healthy. You've got accommodative policy. On the flip side, you have very strong concentration in the market, and so to the extent that you have some idiosyncratic issues where individual businesses don't continue on the path they've been on, that will spike volatility. And so it's not to try and say, okay, I think we're going to see significant increase or decrease. It's just to say there will be pockets of volatility within that, but actually for the most part, there's a push and pull which keeps us somewhat in an average band if you were to take from now until the next 12 months.
Dan?
It always sounds really smart to predict volatility, doesn't it? Because it's a way of saying nothing but with complete confidence. And but I think, yeah. So if you think about what do people really mean when they say there's going to be more volatility, no one worries about volatility on the upside. Yeah. Everyone only worries about volatility on the downside. It's a euphemism for saying people think markets will fall. So when we're thinking about is that already in the price, then if people do expect volatility, then we'd expect a higher margin of safety in asset prices. We'd expect prices to be lower, and they're not, frankly. Right. We look at a lot of equity markets around the world, we look at a lot of credit markets, even the price of the dollar, then actually there's still a lot of optimism in price as far as we can see. So although people may be saying, oh yes, we can see volatility next year, actually that doesn't seem to be in the price.
Jerry?
Yeah, well, I echo what's already been said. Maybe if I can look at it from a different perspective, obviously the volatility is a reflection of the unpredictability. And one can try and think of the second and third round effects of where will that unpredictability feed through. And given the unpredictability is largely coming out of Washington, it's in some respects a repeat of what we've seen in the last 12 months and comes through in three key areas, I would say. First, it very much reinforces that shift from globalization to fragmentation, from free trade to protectionism, and also means that national security is now up there alongside economic prosperity in terms of driving economic policy making. So what we very much will see is more countries trying to control the controllables. Home country bias will not be a purely US specific focus. We'll see that elsewhere, indeed here in the UK, with industrial strategies. So we're going to see a lot more of that. A second aspect will be very much in terms of geopolitics or geoeconomics. And when one goes across the world, it's almost reinforcing the G3 world, America and its allies, China and its associates, and the middle ground powers, the sort of global south, as people would call them. And then third will be the unpredictability very much comes to the fore in terms of national policy in the States, but that will have global contagion as well. For instance, in the year ahead, one of the big issues will be China's incredible export competitiveness. Chinese manufacturing is so hyper efficient, its currency is tied to a dollar that is weakening. One of the big issues this year will be that China will export disinflation. Now, how will the markets react to that? Because European countries will be thinking, auto industry wiped out, not good. Let's have trade protectionism. Markets will be thinking central banks can respond with low inflation. So it's not that we can anticipate unpredictability, but trying to think where might it manifest itself and what are the consequences of that.
And it's a good sort of link, actually, because obviously within the discussion about unpredictability, we've talked about a whole panoply of different risks. I mean, you mentioned China, trade, AI, corporate earnings. I mean, if we could just sort of drill down into that for a second, if you could each give me one and only one big theme or risk that you think will be, a key component in shaping the direction of equity or credit markets next year. Maybe Luke, start with you on that.
Yeah, look, I think on the equity side of things, I think it will be AI fundamentals, which will drive market, and that's got different component parts to it, but principally it's a capex trend. So what you've seen to date is significant capital expenditure on the part of the hyperscalers to build out models. What that's meant is on the technology hardware side, actually real money earnings for companies. They've actually sold product for real money and they've generated very substantial improvement in fundamentals. I think you're at a point now where clearly the focus on return on capital for that cohort of hyperscalers is becoming much more paramount, but you're not going to see a material shift in terms of their propensity to continue to invest. You're going to see roughly $370 billion of capital investment this year. That's up 55% on last year. It's probably going to go another 25 to 30% just for that cohort of hyperscalers next year. And then notwithstanding where you see sovereigns and governments starting to step in to build out their own infrastructure. And so for us, that puts reasonably positive tailwind to many of the underlying infrastructure and hardware trends that we've seen. But the variance of outcome here is substantial. So if you can't show that path to profitability or improved return on investment, and then significantly if you can't show the application of that technology, so what is then the next step in the software side of things and who are going to be the winners and losers in that, I think that's where the market will start to focus. And you've seen it even in the last couple of earnings prints where if you see a positive dynamic, market is potentially looking at that and saying, okay, here's justification. At the margin, you've seen some profit taking on that, but actually for the most part, fundamentals continue to improve. Where you've seen misstep or you've seen change in direction for some of those businesses, again, the market's penalised that. I think that's healthy, but you take that at the aggregate and you say you've got a subset of companies in the US market that are driving the majority of that universe. Again, return contribution is a little bit lower this year than it's been in the last couple of years, but it's still half a dozen companies making up 40% of the S&P. That's a big constituent part of what the average person is investing in. And so I think to the extent you see some misstep on that front, which is not our base case view, but to the extent it comes through and you don't see the same progression in earnings and fundamentals, that's where the market will start to react off of what are not, in our opinion, bubble level valuations, but clearly elevated valuations that the market will start to focus in on if they don't see the progression forwards.
Dan, from your point of view, big risk, big
Well,
theme?
I mean, I think Luke is right, but we learnt in the 2010 election that simply replying "I agree with Nick" is not great panel strategy. So I had to come up with something different. So I'm going to say that private credit is really the risk that we should be focused on in 2026. So we've seen an incredible increase in the end investor and advisor interest in private credit over the last couple of years. We've seen lots of new products launched. Morningstar's covering a lot of those, and we started that this year to help people sort of separate the wheat from the chaff. But when we see this huge growth in an asset class which is new to most people, is somewhat opaque, is illiquid, then that's normally a recipe for some bad behaviour and some bad outcomes. So I think that's an area that we should all be watching closely in 26.
So you're on the Jamie Dimon cockroach school of thought.
Yeah, I am. It's a much better quote than I could have come up with. But yeah, I think Jamie's spot on. That there's when you see that market starting to crack, and again, as proper analysts, we have to say it's a very diverse market, and that approach, the kind of cockroach approach, is a little bit simplistic, but nevertheless, it's end investors in opaque, illiquid strategies is often a problem.
And Jerry, you've mentioned to me before that you've the debt more generally might perhaps be aware. Is that your?
Yeah, we're heading for a debt crisis. That's the good news. It might not come through next year. Sovereign debt crisis. Markets tend to anticipate these things, so tensions might start to become more evident. Obviously, we saw problems a few months ago in France. We already see a high risk premium built into UK gilts in terms of reflecting sticky inflation and uncertainty over fiscal positions. In terms of the G7, 6 of the G7 are heading for a debt trap by the end of the decade. It matters more for France and Britain because both of those countries are more dependent on international investors to buy their debt than anyone else. So hence in France and in the UK, it's more of a live issue. But a debt trap is effectively when your debt becomes greater than the size of your GDP, so over 100%, quite a few countries already there, and the relationship between G and R becomes key, growth and interest rates. When the rate of your economic growth is less than the rate of interest you're paying on your debt, then you basically have to run a primary surplus, a government surplus, taking out interest payments to actually just have debt sustainability. That's very difficult to achieve. When you think of Britain, we've only had 7 budget surpluses, never mind primary surpluses, since 1969. So it's very difficult for governments to actually get themselves in the position when they're in a debt trap to stabilise it. And it's proving difficult to actually stop us heading in the direction of a debt problem. So debt is really coming to the fore. Effectively, since the global financial crisis in 2008, we've had first the monetary lever pulled as the shock absorber, and we had all sorts of problems with monetary policy. And then the other lever that's been pulled has been fiscal policy. And the pandemic, probably Japan's might be the rare exception, but its debt level was already sky high. And a couple of weeks ago, they were having a big wobble. But every other country in every region has seen debt levels go up in terms of public spending in particular, and in turn debt levels since pre-pandemic. So we're in an environment where Western democracies seem incapable or unable to address the underlying issues that are causing debt to keep on rising. So a debt crisis, I would say, is likely by the end of this decade, but we might start to see that, as we saw with France a few months ago, factored into market thinking much sooner than that.
I'm sure that'll get picked up in the bond panel in a couple of sessions' time. But Aaron, just coming to you on the big theme, big risk.
Yeah, well, starting out with a reasonably optimistic view going into next year, but also acknowledging that investor sentiment is certainly not pessimistic. I would put it on much more of the optimistic side of things, maybe not quite euphoric, but approaching that. We really look out for things that go wrong. So this isn't intended to be a pessimistic view. I don't think a recession is coming necessarily, but it does occur to me that it's been an awfully long time since most investors have experienced just a run-of-the-mill normal business cycle recession. You could argue you need to go back all the way, at least in the US, to 1990 since you've had that, because every other one has been a financial crisis or COVID or the downturn during the tech bust. And so I don't think a lot of people have their eye on just excesses that have built up over the course of a pretty long economic cycle that could ultimately lead you into a minor but not insignificant recession. And I think some of the things mentioned here today could be a source of that excess. It could be excessive AI data center spending, something I don't think there's anything to be pessimistic about there, but if it proves not to be as profitable as hoped, you could argue that's a source of excess. Maybe it's private markets, equity, or credit. I think there are a number of things to keep an eye on that could spark an economic downturn when the economy is growing, but it's not growing at a gangbusters pace, and so there is some vulnerability there. So I think keeping your eye on economic indicators that just might lead you down the path of a pretty normal recession, but one where there's not a lot of institutional experience, I think could be disruptive to the market.
And something that Lord Darrett mentioned in the previous session was obviously next year, 2026, is the year that Jerome Powell will step down from his position and be replaced. And there was a piece in the FT about the market reaction to one of the names, Hassett, that was mooted. We did a bit of our research on our polling on that, and 93% of investors, perhaps unsurprisingly, said that if the next Fed chair was seen as less independent, more of a political appointee, then there would be a significant reallocation of capital away from the US. I just want to sort of get your reaction to that risk in particular, and maybe Aaron, stick with you on this. And is it one of those risks that gets kind of talked about a lot, but isn't going to materialize, or is it something that you're really keeping an eye on?
Well, I do think it's a risk, but we're already starting to talk about it now, and this is going to happen in May. And President Trump has suggested that he might name Jerome Powell's successor here pretty quickly, and so the market will have had a very long time to digest that before the event actually comes. And so I think by the time, I don't think there's a lot of shock and awe left in it by the time you get to May and the actual transition happens. There are a few unknowns out there, like is Jerome Powell going to stay on the board or not, those types of things. But I think the big announcement will probably have come well ahead of that, and the market will have had plenty of time to digest that. And I always think it's important to focus on what people do, not what they say, because when I think about the chaos of April 2nd, I'll call it Liberation Day. I'm not sure what we're getting liberated from, but when you just think about the reaction to that, I heard immediately afterwards, well, this is the end of U.S. exceptionalism, and foreign assets are going to flow out of the U.S. We're back to all-time highs of non-U.S. investors coming into U.S. equities and debt and so forth. And so I think it's easy to say that might happen, but I think ultimately by the time you get to that point, I'm not as concerned about Fed independence. I think mostly, you take the leading candidate now, Hassett. I think his views are clearly very aligned with Trump, but I think that's a different thing than the Fed being non-independent. So I'm not too worried about that.
Jerry, from your point of view?
Yeah, I think the interesting issue is what happens to the dollar. In the last year, we've seen globally a change in attitudes to the States. And we've seen passive diversification from the dollar in the sense that international investors are not selling US assets. They're putting less of the net new money into the States. So the dollar has depreciated gradually. if there was a big issue about Fed independence, and in turn, as you touch on, is what they do, if, for instance, US inflation was sticky and the markets wanted rates to be higher and it was known that the new appointee was going to be driving rates lower, then there's that policy issue. But if there was a question mark, however it comes to the fore, and if that really manifests itself, then there could be active diversification. That is, not just passively the dollar weakens, you actively see a significant fall in the dollar. That would cause problems.
Right. And I'm actually conscious that we've spoken quite a lot about, the US, and we haven't really talked at all from policy side of things about Europe. So just quickly on that, if I may, maybe with Luke. In 2025, we obviously saw the headline policy shift in Germany around the scrapping of the debt brake, but there seems to be a ton of kind of, I don't know, Sturm und Drang in the financial media about, you know, the need for policy reform, and there's a lot of noise, but I haven't necessarily, from where I'm sitting, haven't seen a ton of that translating into real reform or anything that you could potentially trade on. Is that a fair assessment? How do you see the policy situation in Europe developing next year?
I think that's fair. I think if you take the last year or so in Europe, you had some very clear ambitions laid out by Mario Draghi in terms of how you can increase competitiveness within Europe, which I think from a European productivity and competitive standpoint all make perfect sense. It's just how do you implement and execute them at a federal level. I think that did buoy sentiment as you came into the early part of the year, and then coupled with the fact that with what was happening on US trade policy, this idea Europe needed to come together and be much more formalized in terms of its one voice, how we're going to operate. You had this positive backdrop for European assets that were then further buoyed by the fact that actually the big change was this fiscal sustainability consideration. So actually Germany, rather than being at 1.5 fiscal deficit and moving back to, you know, some kind of balanced budget, actually saying, right, I can see that go all the way down to 4, run a deficit, invest that principally in infrastructure, military, defense, hardware that has some circularity and has some benefits in domestic growth. So that is kind of why you saw the first half of the year with European outperformance, and then also why you've kind of seen it temper through the second half of the year, because the follow through of that reform agenda just hasn't been as present. Yeah. Now, our view looking into next year and further forward is you do want to see some of those broader federal level reforms across the EU. I think that would drive competitiveness locally. But actually, there's a lot of things that are already happening independent of that, which will be very positive for growth and the broader equity market backdrop. So you take, for example, the infrastructure spend the EU is committed to on the grid side of things. You're talking about almost 600 billion euros in the next 5 years going into establishing and improving the grid infrastructure so that you can not only improve power generation and distribution, but also so you can actually compete on this AI transition. At the moment, that is very much Europe looking to US as a buyer of US product. If you can actually establish a footprint for servers, for AI infrastructure, then actually that puts Europe in a very interesting position. And I think more formally, if you do start to see growth coming back through in a way that you've seen in parts of peripheral Europe, and you can put that into core Europe as well, the valuation you're being asked to pay for European equities is still muted. You're talking 20-25% discount to US with, you know, at worst an early cycle growth dynamic. And so that for us still looks fairly healthy. You need to be selective in terms of where you're putting that capital to work. There are parts of the ecosystem that look very compelling. There's parts that look a little bit more challenged. Again, we don't want to get too much into the consumer side of things per se, but you do see bifurcation still in Europe as much as you do in the US. But in that infrastructure side of things, in the utility side of things, in the bank side of things, this is a backdrop that actually still looks fairly healthy.
A rare note of optimism from this morning so far. Let's see if we can continue.
Actually, just on the Draghi report, though, it's really quite significant because the first anniversary in September, the FT made a big thing of this. There was 383 recommendations, but only 11.2%, I think it said, had been executed. And there's the mindset change is the key issue. And in the Draghi report in particular, there were, even though he had so many recommendations, there was about 3 key issues, but the most important was the lack of innovation. Yeah. And the key thing that came out of it, he had a great chart in it, was the lack of final stage investment in terms of the US versus Europe. Yeah. EU was down here, the States was up here. Germany will embrace Keynesianism for this year or next year, and they'll have a temporary bounce. But the fundamental problem is that Western Europe is the slow growth region. And you just go around the world, and we just cannot in Western Europe compete with the rest of the world. We don't, here in the UK, we don't do enough comparative advantage. People think the UK is in isolation. And occasionally they might compare ourselves with France or Germany, but that's occasionally. But when you look at the Indo-Pacific, the problems that come to the fore in the Draghi report are comparing Europe with the States. But when you add in what's happening already in East Asia, I think Western Europe really is just not at the races.
But Jerry, just one thing, I agree with all that, but one thing I'd add from an investor perspective, of course, is that it's dangerous to then project that economic view onto the outlook for markets, given that we're typically dealing with global businesses. And I think that's what often gets missed, particularly with all the negativity around some of these markets, that there are some fantastic businesses that are global and benefiting from that growth elsewhere in the world.
And especially if European banks, now they're doing better, if they start to lend, that will probably be the best sort of near-term development.
Yeah. One point I just add, just on, Jerry made the point earlier around national security being much more focal. And I think we automatically shift that to a military defence discussion. How do you build cyber and military defences? There's a supply chain dynamic within that as well, which is very crucial. Is how do you build manufacturing supply chain, resource supply chain that gives you just-in-case supply, not just-in-time supply. And so that's been very much a post-COVID, post-Russia-Ukraine phenomenon where I'll just use a simple example of semiconductors, which as we think about the transformation in AI and foundational within that is semiconductor manufacture, especially as you get to the leading edge of that. As we all know, Taiwan dominates that discussion. 93% of leading edge manufacture is in Taiwan. Why does the US CHIPS Act exist? Principally to bring that supply onshore in US. Why is TSMC building fabs and facilities in Arizona? Because they want to maintain their market share within US businesses. That discussion on subsidization at the federal level of semiconductor manufacture existed in Europe even in advance of US CHIPS Act being formulated. It just hasn't been executed. And so how do you take something that conceptually makes a lot of sense and put it into action in a way that can benefit the aggregate European economy, but also has the ability to be selective in terms of where that investment is going to be going, becomes very crucial in that next stage of competitiveness, but also that fiscal agenda of how you invest in what's needed to drive both growth and advancement in competitiveness.
I'm very keen to leave time for questions, so I'm going to skip my question on the UK because I guess people in the audience might have some interest in that particular topic. But as people are thinking of the questions they want to ask you, a quick fire round to finish. Give me a specific asset class, please, that you would overweight and underweight in 2026. I'm going to start with Jerry because it's unfair because you're an economist and not an asset allocator. So it's purely hypothetical when it comes to you. But we'll start there and perhaps go this way.
In terms of being overweight?
Okay, that you would like to invest in or not like to invest in.
Yeah, I think you need to be globally diversified.
Yeah.
That's the key thing. If you want it to be negative, in the globally diversified, coming back to the point about credit, you don't get really rewarded for taking on incremental risk. So you probably would, in the globally diversified, be underweight credit. But globally diversified, definitely, given what's happening.
Aaron?
Well, this is going to be shocking coming from primarily a long equity manager, but we would say equities, global equities for the coming year.
As we have forever.
Yeah. Dan?
Yeah, I would pick up on on both those points really. I think a lot of, we talk about those great global businesses, and a lot of those businesses, particularly in the US, the ones that dominate the indexes, are pretty richly priced and really focused along that one theme of AI, as Luke mentioned. And so where we're seeing value is digging a little bit deeper. So whether that's markets outside the US, but to be specific, US smaller companies look good value to us, much better value than large companies, and that then brings some diversification away from that single theme. So that's an area that we're seeing that's really attractive at the moment. And on the other side of things, just setting up your bond panel for later on, we'd be underweight high yield credit, where we're seeing their very thin credit spreads. We don't think investors are being paid for the risk they're taking on.
Luke, final word with you before questions.
We've got incrementally more specific, so let me carry that trend.
Which stock? Sorry.
Yeah. Healthcare specifically, and actually as we think about, to what Dan just said, the smaller cap biotech part of the US ecosystem. And what we've had in the last couple of years is the GLP-1 trade, which has been phenomenal for a small handful of pharma businesses that suck the air out of the room on a lot of what is highly transformational technology that's developing in the broader biotech space, you've seen a big shift in pharma mindset over the last 10 years where you effectively were starting to outsource R&D, and then you've, with the build-up of cash in the last 5 years post-COVID, gone, okay, I need to raise my R&D budget. So you've gone from 15% of net sales to 25%. That's actually now starting to lead to some fairly significant evolution in some of the treatments for rare diseases, some of the treatments we're seeing for Alzheimer's, for oncology. And I think specifically the reason we get excited about that smaller cap biotech part of the US ecosystem is because you have so much cash sitting on pharma balance sheets that to the extent they need to re-establish pipeline, your M&A activity in that space accelerates the upside you have in certain pockets of that.
Great. Thank you. Questions from the floor? Douglas? There's a mic wending its way to you.
Thanks. Douglas McNeil from Macro Advisory Partners. Is unpredictability now fully priced into the gold market?
Who wants to take that one? Dan, do you want to take it?
Listen, I know nothing about gold, so I'll wade in because no one else does either. And I think that's really the point, that everyone's got a theory for gold, everyone's got a theory for what it's correlated to, why it's going up, why it's going down. It doesn't have a cash flow, and so it's really tough to value. And I think you're right. People tend to think of it as a safe haven from different risks, which is interesting. So when prices are very high, that suggests that a lot of unpredictability is priced in. But there's no anchor. There's no valuation anchor. So it could double, it could halve. And I think that's why it's so difficult to hold it in portfolios, because there's no starting point for what the right valuation of gold is.
Yeah.
But
the point is, without going into gold, the key thing is liquidity has to be important. Whichever asset you're thinking about is important to go for liquid assets as opposed to illiquid assets in an unpredictable world. But the other point that's linked into the gold debate, you need to be clear why you're buying a particular asset. Sometimes people talk risk on, then they talk generically. You need to have specific reasons why you're buying gold and why it's in your portfolio. It was much cheaper to be buying gold a few years ago, not just in terms of the price, but when you looked at real yields, etc. So if you use it as an insurance premium, it's much more expensive now than it was, not just in terms of its price, but in terms of other variables. So there are different facets coming in here. It's not a yes or no answer. So
I just say the one thing, and not to answer a question with a question, but you need to look also at general reserve accounts, especially across Asia, in terms of how central banks have evolved their underlying ownership structure. You've seen a decrease in dollar and largely gold being the piece of that has increased. So to the extent you view that as structural and a dynamic, it's not to say US dollar isn't Federal Reserve currency of the world, but it's just to say that you are seeing larger strategic buyers of gold that might be structural in nature.
yeah.
Hello, Johnny Jones from TrustNet. Data out this morning from Calastone showed that UK investors are selling and have been selling about 10 billion quid out of equity funds over the last 4 months. So you've all mentioned there that markets are generally optimistic, people are generally quite happy, yet no surprise, the UK investment scene is far more pessimistic. So what is it about UK investors that seem generally to be more pessimistic, and are they on the right side, or do you think that the global consensus is much stronger than our seemingly more downbeat tone?
Who wants to take that? Aaron, do you want to have a...
Sure. Well, I mean, I'll say, generally sentiment just towards the UK, the economy, the government, everything seems to be particularly depressed today. So I'm not surprised to see that come through in some investor behavior. I see that being offset in places like the US, where margin levels are at record high and use of leveraged ETFs are at record highs, and derivatives usage is at record highs. And so, I think generally for Europe broadly, but specifically for the UK, one of the compelling things from an investment standpoint is that sentiment is still quite depressed. Economic optimism is very low. And so the bar to overcome from an equity standpoint, ultimately what drives equities is how does reality play out relative to expectations. I'm not surprised to see that pessimism amongst UK investors, because I think sentiment towards the UK and Europe more broadly still is coming off a pretty low level.
I think, Gerard, you wanted to come in. I think this will be the final word.
Right, just 2 points. First, we've had a very bad budget, but actually in the past, on occasions when we've had bad budgets, the markets have not, and investors sometimes have not focused on the other key variable, monetary policy. So 1981 is the famous time. 364 economists wrote to the Times saying, terrible budget. Norman Lamont's budget was widely seen as being so negative. Taxes went up through the roof. On both occasions, it was monetary policy that really then adjusted, and that allowed the economy to actually benefit. And interest rates, I'm assuming they will be cut in December. The market's expecting gradual easing, but it's possible that you might see that monetary policy lever being pulled. So that's one thing. And the second, very finally, UK businesses, when they're asked about the economy, tend to be really downbeat. When they're asked about their own businesses, they tend to be relatively upbeat. It's not always like that. But in the past, when we've had those divergences, it's often been what businesses have said about their own firms that's tended to win out rather than a view about the overall economy. Savings ratio is high, corporate balance sheets are not too bad. DOBR, we're saying 1.5% growth next year. So it's modest growth as things stand. So there are possible positives there. So it's not all negative.
When people are depressed, get excited.
Yeah, well, I mean, it sounds like a note of, like, if not optimism, then not sort of absolute pessimism to end on. And we'll, if everyone could just say quick thanks to the panelists.